Are dividend-paying companies good for investors, or are they just lazy companies making lazy use of capital? Surely they should be reinvesting for growth. This is Tonight. I'm Bruce Whitfield. Tonight I put Lourens Coetzee of Marriott and Victor von Reiche, senior investment analyst from Cannon Asset Managers, on the spot in an attempt to find out. Let's start with you, Victor. Dividends over time are juicy, glorious and wonderful things, aren't they?
Absolutely. I think dividends it's one mechanism that management can return value for shareholders. I had a look at the Aussie. If you look over a 10-year period, you'd have done about 320% in price appreciation and 460% on a total return basis. So about 30% of your total return would have been from dividends or reinvesting dividends. And if you look at sort of the company level, a company like Sasol, if you bought Sasol in 2004, 8 years later, your dividends would have paid off your shares. And again, about 35% of your total return would have been from dividends. So we think dividends are very important. It comes down to sustainability and of dividends and also management getting the balance right between capital allocation in terms of capex and paying out money to shareholders.
There is that very careful balance, isn't it? And you often see, especially when you've got foreign investors in South African companies, it feels a little bit like an asset strip sometimes. And that's got to be a warning sign?
I think it comes down to company life cycles. So I think the recognition has to be there that if you're looking at a company like a Vodacom, for instance, it's a mature company. Reinvestment opportunities aren't necessarily there. So paying out dividends is the logical thing to do, and for companies in that phase of their life cycle, that might be the best way to optimize value for shareholders. So I think you have to be very careful and realize where a company is in its life cycle and assess the dividend policy accordingly.
Let's go to Lourens Coetzee from Marriott. He's on the line to us from Durban this evening. Lourens, when we look at dividends, you guys are big fans of dividends. You've got a dividend fund. Why would I buy your fund versus going into Satrix, for example, and buying the Satrix Divi as opposed to a managed fund?
Thank you, Bruce, and thank you for allowing us onto your program. You know, for us, I think you're almost asking the difference between an index tracker type fund or a passive type manager fund versus an active. And I think from our perspective, what you're getting from a Marriott Dividend Growth, which is our dividend fund, and what it's trying to do for you is to actively look for the best quality companies that are able to give you an acceptable level of income with, and I think the important word here is sustainable income growth. We're not looking for the most dividends. We're looking for companies that are able to grow their earnings and dividends in the years ahead. And if you look over time, price growth is ultimately a function of income, dividends, or earnings growth over the long term. And if you're in companies that tend to pay out reliable dividends, that grow their earnings over time, you tend to be in the better quality, more financially sound businesses. And if you look at past research, these companies, these dividend-paying stocks, has certainly outperformed if one looks from a risk-adjusted return perspective. But coming back to your question versus us versus the Satrix Divi, for us, you're getting an active management. We're solely focused on earnings and dividend growth, sustainability going forward, and possibly not just looking at which company is paying the most dividends this year. And for us, that's a significant difference, especially where the markets are currently.
I was looking at some stats earlier where if I'd invested R1 million, I wish, in 2004 into your dividend product, in the first year I would have got 40,000 Rand in dividends. Most recent year I would have got 160,000 Rand in dividends from my original R1 million investment. Now that also illustrates the power of growth in dividends over a period of time.
I think for us, Bruce, I think that's really the fundamental deliverable we're trying to deliver for investors. Not all funds are out there trying to give you a sustainable growing dividend stream. If you think about how useful that can be for an investor, you can either live off that income stream or you can reinvest it back and take benefit of compounding over time. And for us, if you can build an income stream while you're saving, you really are, in our opinion, understanding the value of your investment, is what it can give you in income over time.
What are your top 3 holdings in the dividend fund?
Well, they're always going to be good dividend payers. British American Tobacco, it's a great dividend payer. We've got Mr. Price, It's performed extremely well. A bit on the low yield side, but the growth is coming through for us. And life healthcare is also one of the top ones.
It's interesting to see which ones are the ones they choose in terms of the weighting within a managed fund. Isn't the risk here, though, Victor, when we are buying shares to get the dividends, that we're paying an enormous multiple for the shares? Because everyone's playing the dividend game now, aren't they?
Absolutely. I think in this environment of record low interest rate, there's no doubt that certain companies have probably been bid up beyond their fair value based on strong historic dividends.
So we run capital risk if we are buying good dividend yielders.
Absolutely, and it comes down to Lourens's point of sustainability of dividends. And I think there's absolutely a space for active management in this area. Cash flow.
So you would rather go for the Marriott fund than Satrix Divi Plus?
Probably, because there's I think there's a lot of work to be done on understanding a company's cash flow statement. In other words, understanding capital expenditures cycles, what's the working capital demands of a company. And a company like British American Tobacco, which we don't hold in our funds, we think it's slightly overvalued, is a prime example of a company in more in a sort of in a mature phase with not a lot of reinvestment opportunities, but still generating a lot of free cash flow. So that means the dividend is sustainable. It's got pricing power, so it can increase its revenue above inflation. And that means the dividend is probably sustainable for the next 4 or 5 years.
Now, okay, let's go back to you then in Durban this evening, Lourens. I mean, I look at British American Tobacco. I look at what's happening to cigarette consumption around the world. I think the market's contracting by something like 4% a year. You talk about sustainability of dividends. This is the ultimate unsustainable company, isn't it?
I think if you look long term, possibly that is correct. And I think where government and people around the world are trying to stop smoking, from our perspective, if we look at the next 3 to 5 years out, just as Victor said, we see no concern from a dividend growth perspective, dividend payout perspective. And yes, possibly if we do see that going down, we are looking at that very closely. If I can just put you into perspective where we're seeing markets. We're seeing markets generally expensive, just like you've been saying. And for us, we just feel over the next few years, price growth is going to be a function of earnings and dividend growth from the underlying companies. And we are solely focused. We're actively managing to ensure that every single company we've got in our fund is growing their earnings or dividends in this difficult economic environment. And for us, that's what you want an active manager to be doing for you. Not only do you get the benefits of reliable income that comes to you, but think about the income growth over the last decade. It's been inflation plus 8%. So if a guy was living off that 40,000 Rand you were talking about, he was able to grow his income by inflation plus 8 and not touch his capital. So what we find with this strategy is you tend to do well generally over the long term, outperform markets from a risk-adjusted perspective, but you also have downside protection. And I think that's valuable where we are standing today.
Especially, and it's an interesting one, isn't it, Victor? Because here we've got a situation where many people find themselves at retirement without enough capital. So they start doing stupid things with their money, and they go into things like ShareMax, and they start throwing money at Canvas and things like that, going very high risk. Whereas if you can get yourself an income that you can survive off and your capital is relatively secure, you stand a better chance of your money outliving you.
Absolutely. I think people going into those risky ventures like ShareMax, that's probably again a function of the fact that they don't have enough capital. So probably they didn't save enough and they need serious capital appreciation. And that again comes down to the point of steady compounding. If you start saving early enough, you go into good quality companies with increasing dividends, you should be fine.
But that's the point. If we can start investing for dividends younger and not treat them as a retirement benefit, the compounding effect of those dividends over a period of time is just extraordinary, especially reinvesting those dividends every 6 months as they come through.
Absolutely. As I alluded to earlier in the if you look at a company like Sasol, 35% of your total return would have been just from reinvesting dividends. So there's absolutely room for I think it's a good strategy to invest in companies. Some people use a mantra. They talk about a simple, predictable, free cash flow generative dominant company. So those companies.
Okay, you're going to have to repeat that, sorry.
Simple, predictable, free cash flow generative dominant companies. Those
and
are the
in
companies.
English, that is.
those are companies with pricing power where you have some visibility in terms of free cash flow generation, and those companies reward shareholders by paying out increasing dividends over time. So again, valuation comes into it. You don't want to risk capital chasing dividends, and that is where I guess the active management component comes into that fine line between sustainability of dividends and reinvesting enough for sort of the long term.
Lourens, final question for you this evening. What do you sort of see in terms of dividend flows in the next 2 or 3 years? We're going into a very, very difficult phase for the South African economy. If we hit 1% growth this year, it's going to be nigh miraculous. Next year, probably not much better. And the year after that, who knows? How secure are dividends for investors in your funds?
Yeah, thanks, Bruce. I think that's really good because that's our focus at the moment. We solely are focused on those earnings and dividend growth coming through. There's no doubt that dividend growth in the next few years are going to be slower than expected. And from our perspective, that's what's making the market expensive. You've got lower yields than historically, but you've also got lower growth expectation. And if I look at our companies that we're holding, a life healthcare, you've got healthcare inflation anywhere from 6-7%. Historically, it's been 11%. It's come down, but we're looking for 10-odd%. We're trying to be conservative, and if we look across the portfolio, I think we're still seeing inflation beating growth in dividends, but not significant like we've seen in the last few years. But what we feel where you can protect, and if you're looking for a core holding of an equity portfolio for your portfolio, the Dividend Growth Fund. It's got quality companies, it's got growing earnings, it's paying out a 3% level of income after fees, only a 1% level of fee. We think it ticks all the boxes. It's going to be able to protect on the downside, and it's going to grow your dividends going forward.
Has he got a good chance there? Has he got a good chance of meeting those targets, Victor?
I hope so.
No, he hopes so too. He hopes so more than you do. But the point is, are they being overly ambitious? Or do we need to sit back here and go, hold on a second. We've all been talking about 2 or 3 years here. We're worrying about the short-term factors of the economy. 20 years from now, today's assets are going to be cheap, we hope.
Yeah, we hope. I think you want to position yourself in sectors with secular growth. So in other words, healthcare would be an obvious sector to position yourself.
You buy cigarettes, you make people sick, and then you hedge yourself with healthcare. It's fantastic.
Absolutely, hedge your bets. So healthcare would be a good sector. Retailing, those are probably long-term secular growth stories where if you identify the correct companies within those sectors, companies that can either grow organically, take market share by acquiring other businesses or taking their market share, those companies will be, I think, well positioned 5 or 10 years from now and will reward investors with a growing dividend stream.
The power of dividends, the power of compounding that dividend growth. It's a miraculous story. Lourens Coetzee from Marriott in Durban this evening, and Victor van Reiche, who is a senior investment analyst at Cannon Asset Managers. I thank you both for joining us this evening, and I thank you for watching. There'll be more tonight, tomorrow. Till then, good night and goodbye.